I would like to recognize a few more of our sponsors. A big thank you to Monsanto, Sanford, and the South Dakota ethanol producers. The summit would not be possible if it were not for their generosity. Jody, I promise this is the only time I'm going off script, but I would like to thank all the employees of the South Dakota Department of Ag that make this possible behind the scenes. And if you see them, give them a thank you, but go ahead and recognize all the South Dakota Department of Ag employees, because it does not happen without their work behind the scenes. And I know Secretary Jaspers, any of us that have been in those positions, appreciate all the work that they do. Our next panelists know all too well what we have been feeling the last couple of years with the current markets. Mike Pearson is a farmer, former banker, and host of a nationally syndicated market-to-market television program since 2012. He and his wife Heidi run a cow-calf herd and farm outside of Grinnell, Iowa. His presentation today includes an update and an outlook for the farm markets and the global trends impacting these markets. Dr. Matt Roberts is the founder of Kermantle Group, a risk management consultancy in Columbus, Ohio. Previously, Matt was an ag economist at The Ohio State University for 15 years. Dr. Roberts is a nationally renowned expert and speaker on the grain and energy markets. He received his bachelor's from William Jewell College in Liberty, Missouri, and a PhD from North Carolina State University. Prior to graduate school, he worked as a commodity and energy broker in Vienna, Austria, and is a market research consultant to the pharmaceutical industry in North Carolina. He speaks approximately 50 times per year around the nation on grain, petroleum, and biofuels markets, and is also active consultant in the commodity industry. Gentlemen, welcome to the Ag Summit. I'm going to turn it over to you.
Oh, thank you, Craig. Really appreciate it. Really appreciate the opportunity to get up here to Aberdeen. And how many folks are from west of here? A couple of you. All right, I like to be engaging. So I'm going to ask you a lot to hold your hands up today. So those of you west of here, how bad's the drought? Terrible? Yeah. All right. Well, that's what I was interested to come up here, take a look, see how everything is going in South Dakota, because we are facing a challenging year this year. We're facing a challenging year across the spectrum in agriculture, and today, Dr. Roberts and I are going to kind of divide and conquer, if we will, the markets. I want to talk about the livestock markets, what's ahead in the world of meats, and then Matt's going to fill us in on the grain. So this is going to be kind of fun. You know, I apologize if I seem kind of nervous today. It's one of those things where it's not very often that you have 3 doctors on a panel in the morning, and then I've got to share a panel with another doctor, and I spent 7 years in college, but it was just for a bachelor's degree. So I'm feeling a little out of my element. All right, but we're going to try. We're going to try to work through it. Of the folks in this room, how many here are livestock producers in one capacity or another? All right. Of those of you that raised your hands, how many are in the cow-calf business? All right. Do we have any feedlot operators? All right. Pork producers? Any dairymen or women? All right. Am I forgetting anything? Turkeys? Sheep? All right. So we have a lot of diversity. I love coming up to South Dakota to see that. When I go to conferences in Iowa and I ask that question, who here's got livestock, it's one guy in the back who'll raise his hand, and I'll say, that's great, what do you raise? And he's like, my daughter has a show steer, and that's it. So it's kind of fun to get here. It's not so fun when we're talking about what's going on in the world of agriculture. We are in a period of uncertainty. We are seeing declines in net farm income across the board. We've been seeing it for several years. It has been painful for a lot of our growers, for a lot of our livestock producers that are still paying stubbornly high input prices, and we're seeing people get very nervous. We're seeing lenders get a little bit more nervous. We're to a period where we have to cross our T's and dot our I's to make sure we can stay in business. The good news is, as we look out to the future, we're going to see another rally. We're going to see another period of profitability. When we look back over the past 115 years in agricultural trade, and I'm just looking at the corn contract here, we can put the same map up for cattle, we can put a similar map up for wheat. We see 4 periods where profitability has skyrocketed, driven by demand. 1916, 1946, 1946, 1973, and 2013. Just about every 30 years, we see demand move us into a new realm of profitability. Roughly every 30 years. We peaked this last one, 2013. When's the next demand bull market going to hit? 27 years from now? Who wants to be in production 27 years from now? No hands? Okay, we got a couple of you. See, this is kind of a downer crowd. Who wants to be retired in 27 more years? All right, who's going to consider it a win if we're still above ground in 27 years? All right, it takes all kinds. The fact is, we're not going to see record profitability in the short term. We've seen it. We have an ample supply of everything in the world of agriculture today, and we'll let Matt talk grains. I'll focus on the cattle markets. Of my folks here who are in the cattle business, who had fun in 2014? $246 feeders, $172 fat cattle. I hope we all had fun. That was a crazy year. We're probably not going to see that year come back anytime soon. We had a lot of fun in 2014. 2015, the market responded, as it likes to do, to price signals, and we began to overproduce. We saw a lot of cattle in the northern Corn Belt in 2015 get very, very heavy. Iowa was to blame, Minnesota, parts of Nebraska, and parts of South Dakota were to blame for walking all of this corn off the farm in the belly of our steers. What happened then was a train wreck. The wheels came off the cattle market in 2015. This is my hay tractor. It's a Minneapolis Moline G900 gas tractor. This is the front axle. That's the front wheel. The hub's back here. And I'm on the seat needing a new pair of pants. Because that's terrifying when that happens. That happened to me last summer. The wheel literally fell off. That's what happened in the cattle market, both live and feeder cattle, when we started putting tons and tons of weight on these animals. The good news is we've rallied. We had some exceptional demand in this country. We saw packers that were short bought. They had to get in here over the past 2 or 3 months and compete for cattle. We saw that drive the cash market much, much higher. We saw that pull futures up. We got some good times. We saw profitability return to America's feedlots. We saw some folks get pretty excited about spending money at the sale barn on some calves. Now we've pulled back. The question of where we sit today in the livestock industry is when we were running along up here, we put this double top in. We were running in a market that was absolutely fueled by good news just about every day. We had the stock market improving. We had home values improving. People were feeling a little bit wealthier. We saw China come back into the market, much talked about. They're going to start buying U.S. beef. We had consumers paying very, very high retail prices for beef. All of these things helped take us up to that double top. What happened here wasn't so much a fundamental change in the market. What happened was a change in psychology. In order to keep this rally going, to stay up at these levels, we needed incredible news every single day. And when we finally heard what China was going to do, they are importing beef from the country, but it's under 3 years of age, right? 30 months. Under 30 months, source verified back to the farm, has to have an individual tracking number. We're not going to be selling as much beef as we had thought in the short term to China, and all those things combined just pulled us back down. Yesterday, limit up. We're finding a new range here in this live cattle market. We do know that we have increased supplies coming on board. We've got more calves being held back, or at least we had more calves being held back. We are going to see this thing bounce back and forth. I'm watching the 115 to 135 level as the place for futures to trade for the bulk of this next year, unless something crazy happens. That's where I see us running. As we look out just a little farther down the line, out to February of 2018, same story. The market, of course, responds to signals across every contract. We're going to watch that same range here. You know, the lack of any kind of carry in this market, we're not anticipating a huge wall of beef soon. Carcass weights have been down. That's really helped us keep these slaughters at a very, very, very strong pace given the time of year, and it's helping us keep this industry current. So we're in decent shape as we take a look at at live cattle. One of the greatest charts that all of us have at our disposal, greatest tools, I should say, is the Commitment of Traders report. Does anybody here check the Commitment of Traders on a regular basis? A couple of you. It's a report published by the CFTC. It comes out every Friday, and it's a report of that Tuesday's market. So who is in the market, who is buying, who is selling. And so for simplicity's sake, there's basically three categories of people in the Commitment of Traders report, three groups of people that trade commodities. Large-scale speculators, the hedge funds that get in and out of industries very quickly, small-scale speculators. If you and I decide to put a position on, we count as small speculators, and commercials, the people that at one point or another are probably going to touch those animals or grains when we take a look at the grain markets. What we can look at is how people are making bets in the market, because we know a couple of things. When large speculators come into our markets, whatever market it is, they move it quite a little bit. They've got a pile of money. They've got trillions of dollars sitting in Dubai and London and Chicago and New York City. And when they decide to invest in a sector, they pour a ton of money in. But let's say they're going along, they're buying contracts. How do you profit from those contracts that you bought? You sell them. So what we can look at with the Commitment of Traders report is how they are buying and selling. So the blue is large-scale speculators, the red is commercials, and the yellow line in through here are small-scale speculators. So what we see is there we go, in about the end of January, we started to see funds take a very, very long position in the world of live cattle. They really amped up that position here over the past month, past 6 weeks, which puts us right in here. This whole rally was driven by these commercials coming into our markets. This is one of the things that has changed in agriculture that we have to be aware of. Ag commodities are now just as much a playground for large global money as the stock market, as the bond market, as everything else. And they do change our bottom line. We are seeing some profitability for feedlots, unhedged steers that have been in the lot coming out this week. You're looking at an average profit of $122 per head. Closeout for hedged steers are down about $2. So all things considered, we have the incentive to continue feeding cattle. One of the things that's really helping us out here is this US dollar index. The dollar is getting cheaper. Ideally, that's going to encourage more of our foreign buyers to get in and make a play in our markets. Buy some more beef, buy some more pork, buy some more beans, buy a little bit more everything, because it's a little cheaper in their currency. This is now not quite a tailwind for agriculture, but at least the dollar, the strength in the dollar, is no longer a headwind, pushing us backwards, making it more complicated, more difficult to get some sales on the books. I want to talk a little bit about the feeder cattle market. Whew, it's been a roller coaster. It has been very, very interesting. We're being driven by the same fundamentals in that feedlots are making money. They're willing to write some checks at the sale barn. The feeder cattle market has me nervous as I look at 2018, 2019. We did hear a lot of herds in Nebraska, Oklahoma, Texas, probably South and North Dakota, Iowa, before the drought hit, of massive heifer retention. We were keeping old cows around the farm a little bit longer. We're going to see more calves coming to market over the next several years. And I'm a little nervous because we're going to have more calves going to the sale barns. At the same time, we have fewer bidders in those seats. We continue to see consolidation in the cattle feeding industry. We've had a couple very large lots close. 2016 was a terrible year for cattle feeders in this country, and that has me nervous as I look out to next spring's calf crop in feeder cattle prices. There is definitely some downside risk. This was yesterday after limit up, trading at 150, 175. We could run this market back down to 130, 120 pretty easily. So if I've got a lot ahead, I want to look at putting on some risk protection in here, going out quite a little ways, because there is risk in this feeder cattle market. Same story as live cattle. We see small speculators make up a huge portion of who's trading in the feeder cattle market. Large-scale speculators, again, aggressive buying, corresponded right with this, and then this spike. So they're going to have to sell those long positions to capitalize on it, which is going to put some additional pressure on the feeder cattle market. I want to talk a little bit about lean hogs, but before I do that, I want to come back to 2014 just briefly. So I'm in the cow-calf business. My wife and I raise Angus cross cattle. Most of them are Angus well, they're cheap cows is what they are. They're the end of the sale barn kind of cows. End of the sale, you know, if they got 3 legs and 1 eye, I'm a bidder. That's how Pearson cattle operates. But my wife was new to the farm, and she's a city girl. We started buying cows in 2012, and she wasn't all that fired up about doing chores every day. Until we had our first bottle calf, 2014. Has anybody here ever had a bottle calf? A couple of you, or your kids have bottle calves. I want to ask you guys a question. Is it a best practice to name something that you're going to sell or eat? Is that a good idea? No. At least not until you fully understand the life cycle of that critter. But 2014, I was on the road quite a bit. My wife was doing the chores, so of course she named our little bottle calf Baby Drew. Baby Drew grew strong, rode in the truck with me, was just a good calf. And I went to sell the calves in December 2014, and I called my wife at work. She works at the hospital. And I said, "Hon, I'm going to sell the calves. Can I sell Baby Drew?" And I could hear her voice catch on the phone. "Do we have to sell him?" And I said, "Well, no. You know, of course, I want my wife to be happy. No, hon, we don't have to sell him. You know, he's already been steered. But we can keep him around another year and then eat him." It was not the right thing to say. She thought about it a little bit, sobbed for a little while on the phone, and then decided I could go ahead and sell him. And loaded up all the calves, hauled them down to the sale barn, told the ring man, I said, "Hey, put this one in Heidi Pearson's name since she'd done the work, make the check out to her." And they sold. It was incredible, unbelievable. I almost made a profit in 2014. Almost had to pay taxes. And picked up the 2 checks and drove home. About 8 o'clock at night, when I walk in the front door, my wife's sitting on the couch. She takes one look at me as I come in, starts sobbing once again. Now, when my wife is sobbing on the phone, I can deal with it, right? I mean, I can hold the phone away from my ear, I can go into a tunnel, I can make it stop. But when she's sobbing in front of me, I get very flustered, right? I don't know what to do. My brain kind of gets fried, and she's crying. "I can't believe you sold Baby Drew. He was the best little calf with his eyelashes and his little ears." And I said, "Hon, gosh, you know, I'm so sorry. I want this to stop. I want her to feel better. I want to watch Law and Order." And so I did the only thing I could think of to improve the situation, which was reach into my pocket, get the check, right? Money should help. And I said, "Hon, I'm sorry we sold Baby Drew, but this is what he brought." I gave her the check. She opens up the envelope, wiping away tears, just still kind of sniffling a little bit. She pulls the check out. She goes, "Huh." This was 2014. She looked at me, and she goes, $1,300? And I said, "Yeah." She goes, well, we should have had 10 of him." It was fantastic, because that's what's gotten Heidi on board with our cattle operation. So thank you, 2014. We'll come back to that in just a second as well, 2014. Lean hogs, incredible expansion in the hog industry. We've got barns going up left, right, and center across the state of Iowa, across the state of Missouri. I understand we've got some more coming in here to South Dakota. We've got more going up in Minnesota. We have 36,000 new daily slaughter capacity coming online in the next 18 months. This market is primed. What's supporting us right now in the lean hog market is bacon. Demand for bacon is absolutely incredible, and exports have been very, very strong. We have been shipping a lot of pork to China. We've been shipping it to a lot of our other Asian buyers, and those two factors are combining to give us really pretty excellent margins in the world of lean hogs. We had the pork cutout, trade over $100 for the first time since the PEDV epidemic back in 2013-14. People are buying pork. They're buying it in this country. They're buying it around the globe. And that's why I'm excited about agriculture as we look out to the future. I'm excited for this right here. 2014, I want to come back to that point. 2014 was an exceptional year for a lot of reasons. It was exceptional for livestock, for cow-calf producers, feedlot operators, and it was exceptional because we had unbelievable demand. 2014 was the year of the demand run in the cattle industry. We had consumers willing to spend record amounts of money at the retail counter on beef. Well, let's think about that. One of the things we have to wonder is why? Why that year? Why 2014? Why were they willing to be so aggressive with their purchases? And if we look at it on the macro scale, the world economic scale, or at least the US economic scale, there's a lot of moving pieces. But if we focus it and compare it to our lives, 2014 actually makes a lot of sense. When I graduated from college, I was hired by a bank in East Central Iowa. Moved away from the farm, moved over to Grinnell, Iowa, where I live today. And this was 2008, and I was hired by a bank as a mortgage lender, writing home loans. In 2008, the depths of the housing crisis. I'm fresh out of college. I'm newly married. I'm just trying to get my feet planted in the world, and I'm new to banking, new to this community, new to the world of mortgage lending, which was an industry that nobody wanted to touch with a 10-foot pole. People weren't buying houses to save their lives, and I worked on commission. That's a recipe for poverty. And what happened was for the first 4 months of my married life, every day I went into work, every day I'd go home with nothing to show for it. Made no money, $0. My wife and I were spending all of our money on credit cards. We were slow paying all of our bills. We were crossing our fingers before we hit the light switch, hoping they hadn't shut off our power. Living on peanut butter and jelly sandwiches, on store-brand white bread, and ramen noodles. Anybody been there before? 3 of you? Wow. This is God's country up here in South Dakota. All right, for the rest of you, it sucks. It's miserable. And we struggled like that for 4 months, and finally a doctor moved to town. Bought a big house, I wrote the mortgage, got a big loan, got a big commission check. Does anybody want to guess what my wife and I did that night when I got that commission check? Party. Kind of. How did we party? We went out and ate a steak dinner. Anybody else done that? 4 of you. All right, a lot of vegans in this crowd. That's unexpected. No, we went out and we celebrated with the highest quality protein we could afford, which in Grinnell, Iowa is the Grinnell Steakhouse, and they've got about a 3-inch thick ribeye that is excellent, and that's what we did. So let's look at 2014. We saw the same dynamic taking place, only it wasn't just my wife and I looking to celebrate. It was the entire U.S. middle class. They'd been battered by the worst recession since the Great Depression. They'd seen hours cut. They'd seen jobs lost. Uncertainty was everywhere, beginning in 2008 on up through 2013. That's when things started to improve little bit by little bit. We started to see the unemployment rate begin to decline. Hours worked began to increase. People were taking home a little bit more cash. America wanted to celebrate. And they couldn't go buy that brand new vehicle. They couldn't go on that dream vacation to the Bahamas, but they could pull the cover off that Weber grill that had sat on the patio for 4 years and grill a ribeye. That's what they did. One of our analysts on Market to Market lives in Chicago, and he was at his downtown meat shop, butcher guy, and this was August 2014. He sent me a picture of the meat case, and they were selling ribeyes for $25.99 a pound in 2014. And I said, God bless him, that's fantastic, but who's going to spend 25 bucks a pound? And he sent me a picture back of the line at the checkout of people buying beef at record high prices, which is what brings me to this chart. What I'm looking at here is the spread between retail meats. So we're looking at the spread between beef and broilers and the spread between pork and beef. And what we see is that in 2014, the spread went to record large levels. Beef was priced way more expensive than poultry. Beef was also priced way more expensive than pork, and consumers still were willing to buy it. 2014 is a huge lesson for those of us in agriculture, especially as we look at a challenging year like this one. 2014, beef market was a U.S. issue. Tight U.S. supply meant very, very strong U.S. demand. But the reaction we saw from consumers shows us just how far people are willing to go when they decide they want high-quality protein and they can afford it. So while this was in the U.S., I believe we're going to see similar examples play out globally. We're going to see people transitioning from a plant-based diet to an animal protein-based diet, which is great news for our livestock producers, and it's good news for our row crop feed producers as well. There's baby Drew. That's a little baby calf. You can see he did ride in the truck with me. Pearson trucks are pretty well fully depreciated by the time we're done with them. What we see happening is herds and flocks are growing in this country. We are really and aggressively increasing the amount of protein produced in the U.S. But our increase is just a drop in the bucket. This is the developing world. This is the developing world. We're seeing herds and flocks expand exponentially when we look around the world, particularly at Southeast Asia. This is the hotspot for protein agriculture going forward. This is a place where meat consumption is increasing very, very rapidly. Over the past 10 years, Chinese per capita meat consumption increased 42%. That's huge. 1.3 billion people eating 40% more meat in 2016 than they were in 2006. That is what's going to propel us into the future. We do get some people nervous about China because their economy is transitioning. They're moving from a manufacturing-based economy built on cheap labor to a services-based economy, and that's going to slow their growth rate a little bit. Are we going to see over the next 10 years another 42% increase in Chinese meat consumption? I doubt it. But I'm still very optimistic because as China moves away from being a manufacturing economy, they're pushing those manufacturing jobs to other places in Southeast Asia. In fact, last year, Vietnam surpassed China as the world's largest importer of cotton. Textiles are very susceptible to labor costs, and as they've increased in China, textile manufacturing, clothes making, has moved into Vietnam. So we saw 1.3 billion people begin to really increase their diets, increase their per capita income, and now that's slowing, but that growth is being pushed out to the rest of Southeast Asia. We've got another 1 billion people in Indonesia, Thailand, the Philippines, and Vietnam. We're going to continue to see this demand for meat accelerate as we look out into the future. We do have a couple challenges. The first one is water. We are going to be fighting over water in this country going forward. The water issue is the issue that environmental groups have seized upon. Makes a lot of sense. We all want clean water. It's fairly easy to paint agriculture as a villain in the battle over water because we're irrigating, so we're pulling it out of the ground, or in Iowa, we're over-fertilizing and we're creating runoff. This is the next battle we're going to be fighting. And the reason it's going to be such a battle is because so few people understand agriculture anymore. We live in a world where 50% of Americans live in just the blue counties. 50% of Americans live on less than 10% of the U.S. surface area. Those people are increasingly disconnected from agriculture. When those folks look around at what constitutes a farm, their most recent memory of ag is 3 generations back. That's the great-grandfather. Man, how do we tell our story in agriculture? That's going to be the huge challenge that's going to face us going forward, because we're going to be more efficient. We're going to continue to produce food and respond to market prices. We have to tell a story that the public can relate to. And I believe the best way to tell that story is to talk about how we got started. What got you into this business? Why are you in agriculture? Why are you a farmer and not an insurance salesperson, not a dentist? We have a passion for this career. And every one of us, when we got started, we probably made some mistakes. And I think back to when Heidi and I were dating. My wife and I were dating. And she knew that I wanted to raise some cows and just kind of be a hobby farmer, a gentleman farmer. And I told her, I said, hon, if we ever get the chance to buy a farm, I want to buy a 3/4-ton pickup truck with a gooseneck livestock trailer. Because when I was a kid, we raised hogs, pasture farrow, pasture finish, and we would haul hogs to the buying station in the back of a 1982 Mercury station wagon. No joke. And if any of you, does anybody here have kids in high school? If you want to guarantee there's no funny business on prom night, you let your son drive an 82 Mercury station wagon to prom that still reeks of hog urine. No funny business, I guarantee it. So I really wanted a truck. And my wife said, that's fine. She grew up in town. She hadn't priced a 3/4-ton pickup truck. So she agreed. She said, yeah, that's great. So 2012, when we bought our farm, I said, hon, let's go truck shopping. We ran into town, started looking at trucks. I wanted a Dodge Ram, the Cummins diesel engine, because I want to leave a stoplight in a cloud of black smoke. Deep down, I'm a 12-year-old, and I'm sticking that way. So I wanted to come, and so we pull into the Dodge dealership. We make a pass. We can't afford any of it. Don't have the money. It's just sad. So I told Heidi I was going to keep looking. A little bit later on, February, I'm coming back into Grinnell after taping Market to Market, and I make my loop, the used car dealership, to see what they got. And I saw out of the corner of my eye, in the farthest, darkest corner of that dealer's lot, was a red pickup. I pull back by it. It's a 1990 Chevy 2500, the gas engine. That'll work. That'll work. I get out of my car. I go up to this truck, and I brush some of the snow off the windshield. And right there, in the center of the windshield, taped to where the rearview mirror should have been, was a price tag. It was $999. That's in my budget. Went home, talked my wife out of the checkbook, went back in the next day, took it for a test drive, and bought it. I walked out of there with a pickup. I ended up spending $750 because the dealer wanted it gone. And this was my first truck. This was the first capital equipment purchase we made at Genuine Pearson Cattle Farm. There's a tow strap holding the bumper on. Has anybody owned one of these trucks before? Does anybody want to own one today? See me afterwards. Bring a trailer. It's not going to make it to South Dakota. Those are the stories we can share in agriculture that remind people that we are business people, we are family-oriented, and we're focused on caring for the future. Talk about where we've come from, talk about what we've learned, and where we plan on going from here. Thank you guys for the opportunity. Now we're going to turn it over. Put a big, warm welcome for Mr. Dr. Matt Roberts.
Wow, that's a fine introduction. Can I have that, yes, sir? Thank you, thank you, thank you. That is a fine introduction, and I just don't know where to go with this. I like to pride myself on being the funniest agricultural economist in the country, but that's really faint praise, and fainter still when it's following you. as we've just heard, it is one of the things I like to start with is to talk a little bit. I'm going to kind of build on where Mike just took us. Is the time, the real amazing era in which we live, and why it matters so much for agriculture. And it does build a little bit, like I said. This is a chart that I've started almost every presentation over the past 10 years, this or some variation of it with. This is, first of all, I want to give credit where it's due. It's by a website called Our World in Data. It's a fascinating, fascinating place. I like to call it kind of digital Prozac. If you're ever feeling down about the state of the world, ourworldindata.org. It's a few people who've just collected a tremendous amount of data from all around the world, all different sorts of data sets, things like average per daily caloric consumption of men in England since 1300. The cost of indoor lighting since 1000, how much it costs to light an indoor room since 1000 AD to the present. And what this is the percent of the world's population living in poverty from 1820 to the present. Okay, we can go back here on the left side of this in 1820, depending exactly how you measure it, between 85 and 95% of the world lived in absolute or extreme poverty. This is on, think of it as $1.90 a day or less in current dollars, so extreme poverty. When we come up to, by the time we come to 1980, 44% of the world lived in extreme poverty in 1980, 44%. By 2015, we were at 9.6%. So from 1980 to 2015, we've gone from almost half the world's population living on $1.90 a day or less to under 10%. I showed this, in fact, last fall at Ohio State to my grain marketing class, and I was talking through this. And they kind of looked at me, and one of them said, well, yeah, half the world lived in poverty in 1980. You still had outhouses in 1980. Look at him and go, no, it wasn't that long ago, right? But so you think about today, a kid in college right now would have been born in the late 90s. In the late 90s, 30% of the world lived in extreme poverty. So in the lifespan of a current college student, we've gone from 30% to under 10%. The amount of wealth that's been created, the amount of poverty, the extent to which poverty globally has declined over the past few decades is unprecedented in human history. And it's not just a percentage thing. This is the number of people living in and out of poverty, of extreme poverty. Absolute terms, we go back 1970 at peaks. We had about 2 billion people living in extreme poverty in 1970, and about 1.5, 1.6 billion living above it. Today, 6 billion living above it, about 900 million living below it. And the reason this matters, particularly for agriculture, just as we just heard, what do people do when they get wealthier? Okay, it is human nature. This is not Western thing. This is not an American thing. This is not a rural thing. It is human nature that when people get wealthier, they eat better. Okay? And it's not just in these conversations we hear so much about China. We hear so much about Chinese meat consumption increasing by 42% over the last decade. And oftentimes I get asked, well, what's going to happen in this next decade? We've got all that growth, now what? But the reality is that's the tip of the iceberg. Why? Because the meat that's going into those diets, that's the meat that we don't eat in our diets. Anybody here oftentimes, we're in agriculture. How many times are you in front of a non-ag group talking about ag? Pretty often, right? If you're ever in front of a group of young people, ask them when the last time they ate. Ask them how many of them have even eaten a non-muscle cut of meat. By the way, be ready to explain what that term means, okay? When I was in my class at Ohio State, teaching at Ohio State, classes of 50 to 60 people, and this is in the Ag Econ department, so this is in the College of Ag, typically out of 50 to 60 kids, I would have 8 who had knowingly eaten a non-muscle cut of meat. I didn't really tell them about the hot dogs, okay? Right? But I mean, the idea, we live in a wealthy enough society that when we think about beef, we're not thinking about the heart. We're not thinking about the liver. We're not thinking about the tongue. Right? We're thinking about, is it T-bone? Is it sirloin? We're thinking about those muscle cuts. And there's this entire continuum here of wealth. Down here, in fact, when you're extreme poverty and you're getting wealthier, better food choices means adding vegetable oil, because you're ending up with a more complete amino acid profile by adding more and more oil to your diet. It's something that the UN, the Food and Agriculture Organization, uses to index extreme poverty, how much fat and oil is in the diet, okay? And so then you get up here and maybe you start adding meat, but again, it's really low quality, cheap meat, right? It's the offals. You go, I've spent a lot of time, I have 2 children that we adopted from Colombia, and so I've spent a lot of time in South America over the past decade. And when you go into the supermarket there, even the nice supermarket, the meat case is larger in the non-muscle cut than the muscle cuts. There's a greater selection of non-muscle cut than muscle cut beef or meats in the good supermarkets. Okay? And so as you get wealthier, maybe up here you actually start to get into these muscle cuts that we think about as your wealth improves. And then suddenly, somewhere in here you start maybe with your muscle cuts of pork or chicken. And then you start finding out that, you go a little higher and you find, hey, the part of the hog that tastes really good is the belly, the bacon. And suddenly that's great, and you get a little wealthier, and you're now starting to give names, not to the calves, you're giving names to the steaks, right? Steak's no longer enough. And you get up here and you find out that, what tastes really good is steak wrapped with bacon. Okay? And then you get really wealthy up here and you eat nothing but vegan tofu, which I don't understand, but that's 2017. But there's this whole continuum of food choices. And at its core, the demand that we have seen, the demand growth we've seen, is driven by wealth, because it's human nature. The beginning of time. When the prodigal son came home, what did his dad? What was the first thing his dad did? Slaughtered the fattened calf. He celebrated with food, right? So, Chinese meat consumption, looking at a slightly different way than what we saw. Swine, this kind of teal color here, that is pork consumption from 1975 to the present, million metric tons. Just huge, huge growth. Chicken there in the orange, also way less, but still a lot of growth. But it's all about pork. China is the world's largest consumer of pork. They're the world's largest importer of pork. They're the world's largest producer of pork. Okay? Let's see. I thought I had that. I'm sorry, I left that out. My apologies. The world's largest producer of pork. Half the world's hogs, regardless of how fast we're growing the industry in America right now, half the world's hogs are grown in China. So China is raising more hogs right now than the rest of the world combined. Okay? Massive, massive growth in hog production, and still the world's largest importer of pork. And so if you're going to do that, we've got to feed. If they're going to raise that many animals, they've got to feed that many animals. And so this is oilseed consumption. This color, this is soybeans right here. And you can really see in the mid-90s is when total oilseed consumption exploded, and the majority of it, obviously, soybeans. Again, why? Ultimately driven by wealth, driven by meat demand, driven by demand to raise those animals. Okay? Now, as we've done that, and so that sets the stage. Ultimately, and I don't go through it for the sake of time here, you can find some other slides where I have, or we can talk afterwards. You want to talk about that price, that run-up we had, that once a generation, as I like to talk about it, price spike we had from 2006 to 2014. We hear a lot of causes for it. Okay, we heard a lot in ethanol, or we heard a lot in ag that this is all caused by ethanol. I mean, let's be honest, that was like the best excuse ever. I actually saw there was an editorial in the New York Times that asserted that the crash, the Sullenberger crash, airplane crash, was actually caused by ethanol. You can go look it up. Okay? We heard all about that, but in reality, you could estimate the relative effects of ethanol versus Chinese demand growth, and Chinese demand growth was 2.5 times the impact of U.S. ethanol production. 2.5 times that meat demand, that demand for food from wealth. So that's what led us to where we are. That's what led us to the prices that we're at. Okay? Massive demand. Now, there are other things that were going on. There have been some droughts. There was ethanol demand. There were other things, but ultimately it's been driven by wealth. But when we talk about where we're going, my thunder was a little bit stolen. Yes, once a generation. There will be another spike. When you look closely, what you see is about every decade, there is a price increase. There is what we saw in '96, typically drought-driven. Much more short-lived, much less peaky, smaller travel. But it's there. But about every third or fourth decade, you get this super cycle. And that's what we've been through, okay? So as we talk about where we're going now in agriculture, talking on grain specifically, this is world grain stocks. Now, I'm going to use a graph that looks like this 3 or 4 times. So I want to take a moment to explain it. The green bar up here is production. Orange is use. These black, in this case, it's million metric tons. That'll change. It gives you kind of relative idea, use versus production. This black, the height of the black bar right there is stocks, ending stocks. In this case, this is global world grain stocks. But the real number that matters is this number in the box. Right here, it's 26. That's the stocks to use ratio. It says the 600 million metric tons of inventory that we are going to carry out in the current marketing year is about 26% of a year's usage. And it matters because agriculture's been expanding. There was a time when we heard about a 2 billion bushel carryout in corn, and that was huge. That was tremendous. That was also when we produced 9 billion or 10 billion bushels a year. 2 billion bushels in a year of 15 billion bushel production doesn't go as far as it once did. So we need to think of it in terms of percentages. 26%, why does this matter? Well, from 2013, we know that we have more inventory than we did, but it's 2013 or 2003 to 2014 all had less than that. Previous 2 years, we're tighter than we were the previous 2 years, but we have to go back to 2002 to get those levels of inventories other than these past 3. Again, we've moved out of that super cycle phase. We turn to corn particularly, and we actually see globally corn stocks are back where they were in 2012. Keeping in mind, a lot of what we saw, that second half of that super cycle from 2012 to 2014 was driven by short yields in the United States in corn. Globally, we've seen a drawdown compared to the past 3 years. The global corn market is tightening up. In the U.S., feed use continues to grow. Good animal profitability. You have the genuine Pearson cattle company. Were there some imitation Pearson cattle companies that came before you, or is this a copyright issue? Gotcha, all right, just checking. I personally am a 6% owner of the Adonis cattle company in southwest Missouri. So my guess is it has just as much an impact on my taxes as yours, right? But we look at it, we see profitability. It's another year. I think this may be the 3rd or 4th year since I actually got that the profits on that cover the cost of the tax preparation of adding one more K1, right? So with that, it means that we are seeing herd starting to come up. In this, I think USDA is actually projecting a slight decline right now for next year in total corn consumption. I don't think that's going to be the case. I think we will actually see increased corn consumption to feed use next year. We are seeing grain-consuming animal units nationwide going up, cattle stocks climbing, hogs exploding. On the eastern Corn Belt, we've seen a rapid expansion in hog production, all integrated. We're seeing a large new packing facility going in southern Michigan. And what we're seeing over and over again is the role of contract production in transition or in young and beginning farmers. And that's really been a driving force. A lot of young and beginning farmers starting out at integrated production. Why? It's an easy story to tell the banker. It's an easy bit of base load cash flow. Not huge returns, but steady returns that then hopefully can be leveraged into a broader farm. Ethanol use continues. Food seed and industrial use is slowing. We are continuing, and I'll be honest, as somebody, when I was a broker, I worked primarily on liquid fuels in oil, gasoline, fuel oil. So when ethanol took off, I was at Ohio State at that point, spent a lot of my early career working in the biofuels industry. I'm actually pretty surprised, and I think most of the industry is, or most analysts are, how much growth we've continued to see over the past 3 years. Many people really saw 5 billion bushels, the 15 billion gallons, being a pretty hard cap. And it's been impressive. We now are seeing a couple greenfield plants being built, in addition to more and more plant expansions. And in fact, we have one that's doubling in Ohio this year and next, doubling its capacity. But exports, for as much as we talk about exports, the reality is we haven't seen a big pattern. The United States in corn, okay, and if you look at wheat, you'll see the same. The sad reality is, for as much as we talk about the role of exports in agriculture, when it comes to corn, we've become the world's residual supplier. When the rest of the world is short, our exports increase. When the rest of the world has a lot, or when we're tight, our exports decline. It's very much a third-class citizen when we think about the three legs of demand in corn demand. So there's not this long-term trend that we would like to think there is. Each year, if you watch the USDA, they start with about a 2 billion bushel export forecast. And then it changes throughout the marketing year based on how much competition we have. So the overall stock situation in corn in the United States, we're going to end up with a little more than we did, but we are still not looking at, right now, ample production. Now, what are we talking about here? We're talking about numbers based on trendline yield, June acres. We're still, from a statistical standpoint, looking at this in a very rosy picture. The reality is, as we look across the country, we know that there have been challenges. We know we're not, or I think it's safe at this point to say 170 plus is pretty unlikely. But that's where USDA is at, and that's where I pull these. We will see this tighten. We know there's been weather damage. Western Corn Belt, there's been damage. Eastern Corn Belt, we've had a lot of damage as well, slightly differently. A lot of flooding at planting. I've seen a lot of fields, even the past few weeks, that are only thigh high. A lot of cornfields that are thigh high, which is not what we are used to. I've seen many others that are already taller than me. Huge amount of inconsistency in stand quality and in development in the Eastern Corn Belt. The problem is, this is why I kind of like coming out here and talking about markets. In a lot of ways, we're alike. Okay? We all can think of years in which Eastern Corn Belt's had a bad year, or Western Corn Belt's had a bad year, and it doesn't really matter because the I states are doing just fine. Okay? We don't really see the big market reactions. We're still in July. The market's pricing that damage in, but the crop can still improve. We're still in July. There's a lot of time left. History shows that. Also, international availability exists. There's not this big multi-region catastrophic drought like we've seen in some past years. From a marketing perspective, the first question I would have to every grower, are you up to date? Have you caught up with your marketing plan? Are you where you should be in July for your marketing plan? Because if not, now, it was better 2 days ago when I wrote these slides, but now is still a relatively good time to price. We've seen, this is our third run above $4, okay? And every time growers, in the heat of it, they have those selling orders sitting there at 405, 410 on the board. Market breaks 4, and they become what are known in the industry as good till close. I want to sell at 410. Ooh, but we're at 405. Now I want to sell at 425. In the heat of every rally, guess what? It always looks like it's going to go higher. That's why there's a rally. And so we're at a point where these are prices that 2 months ago, a lot of people would have loved to have had. We still have them. Okay? Now's the time to catch up on those sales if you have. At the same time, a lot of places I've been to, I know guys that are oversold who are in those pockets, whether it's hail damage, we've seen some vicious hail, whether it's eastern corn belt and a lot of flood damage, and we're still getting significant flood damage. Downtown Columbus, Monday, downtown Columbus, there was 18 inches of rain sitting on High Street, which is the main north-south thoroughfare in Columbus, Ohio, a city of 2.5 million. 1.5 feet of water, standing water all night. Okay, we've had tremendous amount of rains. We've seen actual flood damage already. I do know guys that are worried, that are oversold. I know that there are ones here, as we go here, west of here, that are also worried. You're oversold. Here's the good news. In corn, there's still a carry out to 18. You can roll those contracts out to 18. You can roll those out to 18. You can actually move those prices up and worry less about where you're at. If this goes nationwide, full-blown drought, and you're caught wrong way around, not enough bushels to deliver, the reality is you're not going to have that carry. And as a bonus, I'm willing to bet if we get back together next year at the summit, we're not going to have new crop 18 prices where they are right now. Okay? The reality is I'm more than willing to make that bet. Certainly, again, that was an easier thing a few days ago when this was 4 and a dime. Last I saw, we're $3.90-ish. These are prices that over the past 12 months, most producers would look at and say, I'm not saying this is sell the farm prices. I'm not saying that this is sell everything. But starting those marketing, have a written marketing plan and execute it. Okay? World soybeans. Soybeans is where we've really seen that demand growth. What is crazy to think about in beans, I started at Ohio State 2001. If you went to the national organizations in 2001, the biggest point of conversation in soybeans is in 15 years, 10 years, how much of an industry would we have left? 2000, 2001, the expectation was 15 years from then, United States produced corn, South America produced beans. Here we are 15 years later, the United States is producing 46% more soybeans, okay? 46% our soybean production and consumption has increased. By the way, anybody remember what the average price was in 2001 of a bushel of soybeans? Market year average? 5 I'm offered. $4.28. So for you young people, that was soybeans, not corn. Okay? So prices have doubled and we're selling 50% more. That's demand. That's demand. Domestic crush has even started picking up. When I started, all we heard were stories about the crushing plants in the United States being deconstructed, containerized, shipped to South America, shipped to China, shipped to Argentina, Brazil, out of the country. And yet we're actually seeing new plants going up. We're seeing expansion of existing plants. Crush is even picking up. Exports, though, this is the real bright spot. This is the real bright spot. Every year that goes up. Even this year, it still looks like right now we're running about 100 million bushels ahead of USDA projections for this year. We're running faster as a percentage terms than compared to USDA expectations than we ever have. 100 million bushels. So I expect that to go up. Here we are, we look at this year, 11% for the old crop. This number is going to come down. 12% I think is going to come down as well. Realistically, soybeans sound a lot like corn, except long-term demand growth for soybeans is much stronger. The big demand story of corn was ethanol. The big demand story of soybeans is China, is Southeast Asia, is global wealth. That's a much stronger long-term story. Marketing, almost identical advice. We're 10.27 in 2018. Again, that's come down. We're right around 10 last I looked. Not a number that you're going to write home about, but a number that it's unlikely when you think about your 2018 marketing plan, you're going to look back and say, I really think that was an idiotic sell at 5, 7, 10%. Again, depending on what your marketing plan is. World wheat stocks. This is the tough one. What we have seen is 6 years in a row of growing wheat inventories. 6 years in a row. A lot of that driven by hard red winter. Okay, a lot of that driven by U.S. hard red winter. Some of it by soft red winter, also in the U.S. Domestic use of wheat has been flat. Okay, domestic use of wheat has been flat. When we think about corn, I mean, this is, and let me be clear, I pride myself on being an honest arbiter. I'm going to get up here, I'm going to tell you what I see it. What's been the demand story for corn over the past 15 years? Past 20 years? I was a professor at Ohio State for 15 years, and I can withstand an awkward pause longer than anybody in this room when I ask you a question, I assure you. What was the demand story for corn? RFS, ethanol, right? What was it for soybeans? China. What was it for wheat? Gluten-free, right? Scientists have apparently determined that gluten gives us the plague, as far as I can tell. There's actually another one. What's the other one? Low carb. Scientists also discovered that eating bacon makes us skinny. Those are the scientists I like, by the way, right? So there have been demand stories on the wheat side. They've been negative. I really think, by the way, promotion authorities, promotion boards really should be trying to come up with some sort of heritage wheat shake that all the people wearing skinny jeans and riding fixed gears think it improves their health or something. It doesn't need to, because God knows nothing else they buy matters either, but we got to convince them of it, right? The reality is we haven't seen that demand story in wheat over the past couple decades that we've seen in the other crops against which it competes for acres. And that's why it matters. Wheat exports, America is always going to be at a little bit of a disadvantage here because we do a good job in growing wheat. It'd be a lot easier to export more wheat if we did a poor job of growing it. But too much of our wheat is higher quality than what comes out of our export competitors. So overall wheat stocks, again, we're just now starting to see these adjustments in production. We see the big decline here based on this year's lower acreage reductions. Okay? There's been consistent demand growth in wheat in the past 20 years. What we have seen, when we've seen price jumps, it's been driven by short crops. It's not been driven by demand jumps. It's been driven by supply declines. Right now, prices are being driven by the drought and hard red spring. Massive damage, we know that, in the hard red spring, and that's created a huge protein premium. All the rally is really driven by protein. The reality is, the hard red, soft red was a good harvest. Okay? We had solid harvest. We definitely had fewer acres, but solid harvest, not massive issues, but they're gaining just as much from this. For those who are hard red growers, I once again go back to me, this is the opportunity to price 18. Okay? Any 17 that's left, but definitely 18. Why? Because when you're in a short crop situation, when you see a big rally on a short crop situation, you know what it takes to get back to normal? One normal year. Okay? One normal year. And statistically, there's about a about a 68% chance we'll be back, we'll have lower prices next year than this year. Okay? If this goes, in wheat, that's true. In corn and beans, if we carry through to harvest, if we stay at higher prices based on short crops. Okay? So, some sage advice. I'll end it here. Sell on the rumor, buy on the fact. There's a lot of fear in the markets. A lot of fear in the markets. I actually think the sell-off we've seen over the past couple days is driven by, it's strange, it's fact, but it's fact by the uninformed. There's a lot of people who came out and looked at the crop reports and said, oh, see, USDA doesn't think there's an issue. They didn't even adjust yield. Well, of course they didn't adjust yield. It's July. But it's an excuse for the guys with ties, no offense, for the guys with ties, as I like to call them, in the markets, to go ahead and sell. Pigs get fed, hogs get slaughtered. I don't really like livestock except to eat them, so I hear that a lot. It sounds cool, but I tend to think it's probably was started by guys with ties. Okay, but the reality is that's what we've seen with every one of these rallies. People sit back and they say, oh, prices have gone to 410. They're certainly going to go higher. They've gone to 420. I'm not selling at 418, even though I would have been giggly for that 3 months ago. Okay? Even though I would have been giggly. Pigs get fed, hogs get slaughtered. Don't get greedy. And finally, don't play leapfrog with a unicorn. It's nothing to do with ag. It's just good life advice, right? So with that, I'm going to turn it over. Questions, comments, cussing, discussing.
For those of you wondering, the truck has 232,000 miles. I did put a flatbed on it after my wife fell through the bed. That was unpleasant. Yeah. So just see me afterwards.
It was very rusty. That's no statement on your wife.
No, right, yes. Oh, goodness, because we're recording. Very good point. Yes.
Do you see this price cycle actually finally starting to cap or stop the significant increase in acreage, particularly in Brazil, on the corn side? And do we really have to actually, or how do you view the strength of the dollar over the next 2 to 3 years as maybe even having more impact really on South American production? I know that's kind of a broad shot, but a critical piece, I think, of where we're going.
No, it is. It's very important. Yes, the big things that really facilitate South America, or that have limited South American production, has been infrastructure, the speed at which they can expand their infrastructure. And the prices that we had during the commodity super cycle simply made more, there was a larger pool of money both to build infrastructure and to, let's say, lubricate the gears of machines that might slow down the expansion of that infrastructure, which is resulting in, I think, a number of the court cases and scandals going on now. We are already seeing expansion slow down. Corn will always be a challenge in Brazil simply because the areas of the greatest expansion in Brazil, the Cerrados in Mato Grosso, for example, if you've ever been down there, it's extremely sandy soil. I like to call it the world's largest hydroponic farm because if you don't put the nutrient on, the plant doesn't have it available. And so because of the higher input needs of corn, that doubles the infrastructure needs. We've got to bring everything, all the fertilizer in. That's why soybeans have been so popular. Plus, you get a much higher dollar per unit transported in beans there. I do think we're going to see it slow down. Ultimately, we have seen, and this is on one hand, it's hard, we have seen demand outstrip even Brazilian growth. That was the fear for so many years. Brazil was going to put us out of business. But instead, what we've seen is this last decade is there's more than enough demand here for everybody. And as I like to say, hopefully there are not too many Brazilian people watching the live stream. There is a reason certain countries are third world countries. The institutions in Brazil are very weak, and those will be and have been the single biggest limiter to their to agricultural expansion. Not the dollar, not profitability, but government institutions.
And I would just build on that. I think we see the exact same thing taking place in Africa. Tremendous amount of arable land, tremendous opportunity for agricultural growth, but without institutions, without trustworthy institutions, without property rights in a lot of parts of Africa, they're just not going to be competitors. We saw earlier this week end of last week, a series of demonstrations on BR-165, the road up through the Brazilian state of Para. Protesters blocked the road. They lit a semi full of government vehicles on fire and reduced grain shipments down to 25% of usual. So you've got one road that all of these truckers rely on. The growth is going to be slow going forward in Brazil.
Any other questions?
Hi, Mike and Matt. Great to hear your comments. Both of you alluded to and spent a bit of time talking about the importance of China. Can you give some perspective on where we are in the Central Committee's 5-year plan? The last one focused on building consumption in animal protein very effectively. The current 5-year plan is to become more sufficient, sustainable in terms of their own feed production and their own slaughter capacity. They're way behind and lagging in putting that institutional structure in place, which is supporting our exports from the feed side. Where do you think that's going to go in terms of a balance, and where we're going to come to a meeting in terms of their ability to be sustainable? Because that's sort of a pretty important trajectory for the U.S.
First, realize it's always harder, or it's always easier to expand animal livestock than crops, right? The land needs ultimately are much easier to deal with than they are in crops. Crop production has much greater structural impediments in China, regardless of their 5-year plan, and it strikes to the heart of Maoism. It conflicts with the heart of Maoism in a way that increased animal production doesn't. Because in order to move that agriculture into the 20th century, much less the 21st, farmers need collateral that they can use to mechanize, and they can use to adopt newer growing procedures and technology. But that means they've got to own. Where's the collateral in agriculture? Is in the ground. Well, what's the one thing that all communists agree on? The land, the minerals, is property of the people. Okay, so it strikes, and we know that we have seen China move increasingly away from Maoism and Marxism, but it's still, that's a much deeper strike at its heart. So I think it's going to be difficult. The widespread pollution that they deal with, again, is much easier to handle in an animal setting than it is in a crop setting, when I believe the number that I seem to recall is 40% of all cropland has heavy metal contamination. There's a lot of I think the only way that they make that is through creative statistics in the current 5-year plan. I don't believe there's any hope that they move towards it, and I don't believe if they're truly interested in meeting their goals, that in fact they will ever be capable of sustainable production or self-sufficiency in crop production.
Yeah, I think, I don't want to repeat too much of what you just said. I mean, that was an excellent summary. And you look at China's past efforts to incentivize feed grain production, and you look at the massive stockpiles they are sitting on of $9 and $10 corn that is going moldy. As we sit there today, there's so much that would have to change. The notion, and of course, we all kind of know the 5-year plans are suggestions, I suppose, more than anything else. But the idea that that could get anywhere close to being resolved in 5 years is ludicrous, considering they can't get rid of the stocks they have currently. Half of all wheat stocks globally are in China. There's just not a reason for them to completely overhaul their system beyond national security, which is what's been driving it, and those typically don't make the most effective market mechanisms for improving things.
I found some of your statistics very interesting, and one of them that I know a little bit about, and my figures are badly outdated, but I found it interesting that you said the beef going into Taiwan had increased 16%. And the reason I say that is years ago I was over there, and number one, if they've increased their population, I don't know where they're sitting. But number two, they were importing about 80% of their food consumption at that time. And to see them import an additional 16% is very interesting to me, plus the fact that I was amazed at that time at their per capita income. Those people can afford to eat steak. And so I just found that interesting that they had increased that much.
Yeah, Taiwan is a fascinating example of that. South Korea, another fantastic example of that, as they have modernized so quickly and per capita incomes have shot up. And yeah, a little bit of celebration, whether it's beef or, more likely pork and in some cases poultry. Yeah, the demand is exceptional.
This is kind of a two-parter. I hope you don't mind too much. The first is for Mark. You started off your slideshow with a historic price index of crops. I'm pretty sure that was in nominal terms. Is that correct?
Yes.
Okay.
Yes.
I just looked up one in real terms. It's a bit more interesting.
Yes, it is. One of these.
Right. Yeah. In real terms, crop prices have been falling, which is
Yeah. In
always
fact,
fun
in
to
real
hear.
terms, this last year, we saw the cheapest wheat in this country, cash wheat, since 1862. So, when we think about what inflation does, yeah, that's a huge example, cheapest wheat in 150 years on a real basis. But I'm sorry, go ahead.
No. The other one is for you, Dr. Roberts. Oh, yeah. Now you suggested that farmers or anyone really selling grain have a bit of a problem, right? With self-control, it seems. Of course, I do too. Even college is roughing everyone's waistline. But are there any institutions that you can envision being created by farmers, by people in these markets that will help get grain on the market at a more reasonable rate, right, without this desire to hold out a little too long?
So, great question. I would suggest now, while you're in college, if you think college is tough on your waistline, I have bad news about your 30s. So I would go ahead and start practicing now. Creating the institutions, history is rife with examples when those institutions have attempted to be created, and to my knowledge, every single one of them has failed, and failed miserably. Part of it is, in a sense, almost those collective errors and those collective differences of opinions that create the market itself. It is incumbent on farmers to educate themselves and to work. And if it is a weakness, and it's, this is not that different than IRA. I'm no paragon. I can show you. I bought Enron at $14 a share. watched it split 3 times, go to $81 a share, sold my last 50 shares at 72 cents. Okay? So I'm not saying I'm perfect here. I've got real world experience. The institutional thing, I don't believe so. Beyond education, beyond helping farmers understand what risk management means and understand to place less value on the home runs and more value on singles and doubles. This is what I educate. It's a small ball approach. If you're familiar with the Moneyball, the book or movie, it's playing small ball, understanding when that's appropriate and why that's appropriate. So from an institutional standpoint, yeah, there's an educational gap. And that is something that I would argue has grown over the past couple decades rather than shrunk as extension and similar organizations have shrunk as opposed to grow. On inflation, a key thing, although that's a nice, I do not disagree with the facts of what you said. Remember also, we had the highest profit per acre in these past few years that we have had in, I believe, since the 50s, okay, in corn ground, inflation adjusted. And so what we have to remember is that statistics don't necessarily lie, but they can be twisted. Yields have to be included in that. And while we have seen real prices, inflation adjusted prices decline over the past pretty much ever, we've seen yields continue to grow very rapidly over the last 5 decades. And if you look at revenue per acre discounted, you'll see a different story.
Yeah, and I just want to circle back to the idea of institutions that exist to help get grain to the market. And, you know, the big one is the Chicago Board of Trade, Minneapolis Grain Exchange, Kansas City. That's what those markets were created by buyers and sellers to have an orderly way to move grain out. As we look at it, kind of more recent institutions, I think you can point to a lot of the different contracts offered by physical buyers, whether it's accumulator contracts, whether it's, I was going to say HFTs, hedge derived, HTAs. All of those things are ways that we're utilizing the big institution of commodity markets and making it, in some cases, more relatable for producers so they don't have to call a broker and work through Chicago. So I think we'll continue to see those kind of changes moving forward. Great questions.